Hey everyone, welcome to today's Explainer. So today we are unpacking a really fascinating, highly complex, and frankly massive report on the May 2026 Middle East conflict. We're going to break down exactly how an escalation happening halfway across the globe is sending these huge economic shockwaves straight to our own backyards. It's kind of the million-dollar question, isn't it? Well, actually, as we'll see, it's more like a $300 billion question. How did a regional conflict instantly rewrite the U.S. economy? We so often think of distant geopolitical events as, just that, distant. But today, we're going to uncover the hidden links between global geopolitics and your actual daily life. We're going to trace exactly how events miles and miles away are directly impacting American energy prices, interest rates, and yes, even your grocery bills. All right, let's dive right into this. We are tracking four simultaneous shockwaves today. 1, the global choke point. 2, the inflation resurgence. 3, the $300 billion shock. And 4, supply chains and the future. Starting off with Section 1, the global choke point and the Strait of Hormuz closure. Let's just think about this stark before and after reality for a second. Before the escalation, global oil markets were pretty comfortable. You had Brent crude sitting in that $70 to $80 range, and the U.S. national average for gas was hovering around $2.80 a gallon. Then the blockade of the Strait happens, Brent crude completely surges past $120 a barrel. Here at home, pump prices shot right past $4.50. That is a massive 55% increase. And crucially, it is not just consumer gasoline. Domestic diesel literally doubled in price, which instantly drove up the overhead cost for the entire American trucking and freight industry overnight. When I was first going through this report, this specific number just stopped me in my tracks. 600 to 700 million. That is the estimated total number of barrels of global oil production capacity that was lost over the duration of this disruption. To put that into perspective, the International Energy Agency characterizes this as one of the single largest supply disruptions in the history of the global oil market. Now, you might be wondering, wait a minute, doesn't the U.S. produce its own energy? Why is this hitting us so hard? Good question. Well, it basically comes down to the war premium. The Strait of Hormuz is an absolutely vital global artery. We're talking 20% of the world's daily petroleum liquids, plus substantial volumes of liquid natural gas traveling right through that one choke point. When the strait closed, regional exporters had to declare force majeure, which essentially means canceling contracts due to totally unforeseen circumstances. So even though the U.S. is a net energy exporter with really robust shale production, crude oil is a globally priced commodity. Because of that, this war premium unavoidably drives up the feedstock costs for our domestic U.S. refineries, and they pass that pain directly down to the American consumer. Moving right along to Section 2, the inflation resurgence and the real squeeze on American households. So in March of 2026, headline inflation was sitting at 3.3%. By April, driven almost entirely by that crazy surge in energy we just talked about, it jumped up to 3.8%. That's the highest level since 2023. And listen, that is not just a line on a chart going up. That's the cost of manufacturing and food production physically tightening its grip on your wallet. Now, core inflation actually remains somewhat stable, hanging around 2.7%. But because oil and gas are foundational inputs for literally everything from manufacturing to growing food, the longer this energy shock lasts, the higher the risk is of triggering a much broader inflationary spiral. And the data really paints the picture of why that specific inflation is so dangerous. Consumer spending makes up a massive 70% of the U.S. gross domestic product. When we are all forced to dump our paychecks into overpriced gas and groceries, we have to stop buying the fun stuff. It acts exactly like a regressive tax. It heavily curtails discretionary spending, especially for lower-income folks, and that poses a really severe risk to the primary engine of the whole U.S. economy, retail and service sector growth. Because of the severe consumer squeeze, the Federal Reserve basically had to rip up its playbook. Before this conflict hit, financial markets were completely expecting multiple interest rate cuts throughout 2026. But the report notes those expectations had to be entirely recalibrated. To fight off this energy-driven inflation and keep it from unanchoring long-term consumer price expectations, the Fed was forced to pivot to a higher-for-longer interest rate stance. In fact, things got so intense that futures markets even started pricing in potential rate hikes instead of cuts. All right, into our third area, the $300 billion shock, covering the fiscal impacts of unbudgeted defense. I absolutely love this question. How on earth does a missile interceptor fired in the Middle East actually increase your personal mortgage rate here at home? Sounds like a trick question, right? But it's actually this incredibly fascinating, highly interconnected system, and we are going to trace that exact path right now. It all starts with this number right here, $300 billion. That is the projected cumulative fiscal shock to the U.S. economy according to the economic models. It is a completely staggering figure of totally unbudgeted expenditure. So let's break down the actual fiscal math behind that massive number. The Pentagon's initial estimates place the immediate operational logistics and the expended munitions alone at nearly $29 billion. A huge driver of this is just the raw cost of advanced weaponry. Every single THAAD and Patriot interceptor fired costs millions of dollars per unit. You're basically shooting mansions into the sky, and those stockpiles have to be replenished. To rebuild that defense readiness, the administration proposed a staggering $1.5 trillion defense budget for fiscal year 2027. And remember, all of this totally unbudgeted spending is landing on a federal balance sheet where the net interest payments on the national debt had already crossed the historic $1 trillion mark. Let's trace exactly how this trickles all the way down to your personal finances through what we can call the borrowing cost pipeline. Step 1, the government incurs all this unbudgeted military deficit spending. Step 2, to actually finance that, the U.S. Treasury has to issue more debt in the form of bonds. Step 3, this sudden increased supply of bonds, mixed with an inflationary environment where investors are demanding better returns, forces Treasury bond yields to spike. And Step 4, this is where it hits home. Higher Treasury yields serve as the foundational benchmark for consumer and corporate debt. So when Treasury yields spike, consumer mortgage rates, auto loan rates, and borrowing costs for everyday small businesses rise right along with them. And that is exactly how a missile interceptor increases your borrowing costs. And that brings us to our fourth and final shockwave, supply chains and the future. Let's look at freight, flights, and farming. You know, we often just think of the Middle East as a giant oil well, but it's really a critical node connecting Asia, Europe, and the Americas. The closure of standard maritime routes forced commercial shipping into these massive geographical detours, adding literally weeks to transit times and burning vastly more fuel. And up in the skies, it was just as bad. Up to 15% of global air traffic relies on major Middle Eastern airports. Many of those faced closures, forcing air freight to totally reroute around contested airspace. You add in skyrocketing war risk maritime insurance and widespread force majeure contract cancellations, and suddenly you have this severe cost volatility that forces U.S. corporations to just scramble to get intermediate goods and raw materials. But honestly, perhaps the most mind-bending disruption in the whole report is the agricultural one. Watch how this domino effect works. Step 1, security risks shut down Middle East LNG facilities. Step 2, because urea fertilizer production is super reliant on natural gas, global fertilizer supplies tighten dramatically. Step 3, this global supply shock directly hits the U.S. agricultural sector, forcing American farmers to face way higher input costs for their planting season. And finally, Step 4, those higher farming costs ultimately push domestic food prices up, ensuring American groceries will stay more expensive well into 2027. It's just an incredible illustration of how deeply interconnected our modern global economy truly is. All of this leads us right to the looming threat outlined in the report, the dreaded S word. Yep, stagflation. You probably know the drill. It's that nasty scenario characterized by stagnant economic growth paired up with persistent inflation. The report notes that if the conflict remains protracted and the Strait of Hormuz stays closed, the U.S. faces a heavily rising probability of this exact situation. Because monetary policy is already tightened with those higher interest rates we talked about, and federal deficits are just ballooning, the economy simply doesn't have the agility left to stimulate growth. Both the public and private sectors are completely boxed in. And the report wraps up with this incredibly powerful summarizing thought. The 2026 U.S.-Iran conflict is acting as a massive tax on the U.S. economy, extracted straight through energy premiums, inflated logistics costs, and higher interest rates. This whole crisis underscores the absolutely urgent necessity for supply chain resilience and diversification. It really leaves you wondering, how quickly can the global economy actually adapt before these temporary shocks just become our permanent reality? Thank you so much for joining me for today's Explainer, and I will see you next time.